Hello Forex trader. Welcome to this video on the brief history of futures. Futures exchanges have played an essential role in the global financial system for centuries. These exchanges can be traced back to the Tulip Mania in the early 1600s, when tulip traders in the Netherlands signed contracts before a notary to purchase tulips at the end of the season. However, what remained after the first speculative bubble was the foundation for modern-day futures exchanges, with attributes including centralized trading, standardized contracts, and regulation. Then, in the mid-1800s, as Chicago found itself at the center of railroad and telegraph lines, and about the same time, higher wheat production substantially increased due to the invention of the McCormick reaper. Wheat sellers found themselves at the mercy of dealers after traveling with no storage facilities to speak of. This then brought about the standardization of futures contracts where farmers, sellers, and dealers, buyers, were able to exchange a specific commodity for cash at a said date in the future. Simply put, both the buyer and seller now knew exactly what they could expect to receive in advance. One of the key functions of any futures exchange is to provide for the clearing and daily settlements of trades. The exchanges work with the FCMs, your brokerage house, to ensure that all trades are reconciled correctly. Despite the changes that have occurred over time, the main purpose of the futures market is still to provide an effective and efficient system for the management of price risk. Futures are standardized contracts that say how much of a specified commodity can be purchased or sold at a predetermined price, and at a specified time in the future. These instruments are known as derivatives because the price is derived from its underlying asset. All the terms and conditions of a futures contract are predetermined by the exchange prior to trading, but they commonly include the expiration date, the exchange, the tick size and pricing unit, as well as the symbol. For example, the NYMEX light sweet crude futures contract unit is 1,000 barrels, with a minimum fluctuation, tick size, of 1 cent per barrel. Futures can be categorized into several categories offering a wide range of assets to choose from, including agriculture, energy, equity index, FX or currencies, and interest rates. Agriculture includes grains and oilseeds, livestock, dairy, forest, commodity indexes, and SIFTs. Energy includes crude oil, ethanol, natural gas, refined products, coal, and emissions. Equity index includes U.S. indexes, international indexes, and sector indexes. FX or currencies include G10 pairs, emerging markets, FX volatility, and e-micros. Interest rates include short-term int rates, STR, U.S. Treasury, swaps, and interest rate. Now that you understand the brief history of futures and the different available futures asset classes, you can make informed decisions when trading futures. Follow our socials for more Forex trading guides like this. And don't forget to join our Telegram channel for free trading signals. Until then, goodbye.